Hi, today's episode is about something very simple but incredibly powerful. We are asking ourselves the question, what makes a good business? It's not the latest stock tip, it's not a trending chart pattern, but a genuinely valuable business that we can own for many years. Because in the long run, stock price will follow good business performance. Let's break this down properly. So when I am investing in a business, I am asking myself this question, is it a good business? Is it going to be relevant 10 years from now? And what makes it so good today? While doing my stock picking, here are the filters that I personally use in order to filter out a lot of the bad companies. Number one, consistent profits over the past 5 years, 7 years, even 10 years. Can this company make profit year after year? Not just during bull markets, anyone can post a good quarter, but a good business earns steadily across cycles. It's like when you are earning income consistently, it brings you peace of mind, doesn't it? That's exactly what you want as a shareholder. ROE and ROCE. In simple terms, these are capital efficiency ratios. It shows how well a company is using its money to generate more money for the business. ROE. This ratio tells us how much money a company makes from the shareholders' equity. Shareholders' equity is the money that the shareholders provide to the company to conduct business. For example, if a company makes 20 crores on 100 crore shareholder equity, that means the ROE is 20%. The next ratio is ROCE, return on capital employed. This one goes beyond just equity. It also considers borrowings or debt as a capital that the company can use in order to do so many things. Run day-to-day business, takes care of capital requirement, it takes care of fixed asset purchases. It's especially important for companies that borrow to grow. These are generally companies that are small in size and they are aiming to capture market share, and so they may need borrowings in order to grow quickly. A high ROCE shows discipline and smart capital allocation. So the third thing I look at is the amount of debt in the company's balance sheet. A healthy amount of debt is actually good because it can catapult the company towards greater heights, but not too much. Debt is like a double-edged knife. On one hand, debt can allow the company to scale faster without needing to issue more shares. Why is this important? Because this protects the existing shareholders from dilution. But too much of debt, now that's dangerous, especially if the company's profits are slowing down. Because guys, it's not about having zero debt. It's about being able to handle it. The fourth thing I look at is whether the products that the company manufactures is relevant, or is it going to be relevant 5 to 10 years from now? Guys, a real business is built on repeat usage, where the products or the service is going to be relevant many years into the future. Perhaps the market has not even identified that this product or service is going to be useful. Once the market realizes that the demand is real and is long term and not just based on a buzz, then the company has a seriously good chance of growing. The fifth and very important thing to look at is trustworthy management. Retail investors overlook that aspect completely. They think that they do not have access to management, so it's difficult to gauge that. That may be true partly, but there are other ways of gauging how the management is performing. You can go through con calls, you can go through the management report. There's so many ways to see what the management is up to, what the management is thinking. Questions like, are they transparent with shareholders? What is their long-term vision? Where do they want to take the company? Are they focused on long-term growth or short-term results? Are the promoters willing to invest in their own company, or are they unloading their shares? Management is definitely hard to quantify, but over a period of time, once you start reading enough annual reports and conference calls, you start to get an idea of whether the management is being honest, are they lacking focus, or maybe they're talking about something that feels like fraud. Number 6. Moat, a concept which was popularized by Warren Buffett. He often talks about moat, just a fancy term for a business having competitive advantage. So what is the meaning of the word moat? Moat is a water body that surrounds a castle that keeps enemies out of the castle. It acts as a defense where the enemy cannot enter the castle easily. And in the world of business and finance, a moat is having an advantage over your competition such that they cannot enter and destroy your castle. It could be anything. It could be brand strength. It could be a customer habit, maybe a cost advantage because it has a good control over its suppliers and the customers. Maybe it invests a lot in R&D and technology, or maybe good logistics. Basically, any advantage that puts this company away from the competition's reach. So the business earns money, great, but what does it do next? This is where the capital allocation comes in. There are many ways in which the company can use this capital. It can reinvest for further growth. It can use it to buy back shares, which can enhance earnings per share of the existing shareholders. It can reduce borrowings. It can use the net profits to reduce borrowings, which will strengthen the balance sheet. Or it could give a part of the profits back to the shareholders in the form of dividends. Now, here's the key part. If the company chooses to reinvest its profits into the company for further growth, it can lead to a massive ripple effect on wealth creation for the shareholders. Why? Because the net profits get added to the retained earnings in the balance sheet. That not only strengthens the balance sheet because retained earnings is a part of equity, but now when the company continues to earn the same ROE on a larger equity base, then that's going to lead to even more profits for the company, which again gets added to the company, and it just keeps compounding. A good company will just keep compounding wealth for its shareholders. If the ROE is low, then reinvesting the profits back into the company does little for the company and also your investment. That is why a good ROE and ROCE are so important. If the company cannot utilize its capital properly or efficiently, that is when it makes more sense for the company to return the profits back to the shareholders in the form of dividends or buybacks. So in a nutshell, capital allocation isn't just about where the money goes. It is about how efficiently the money is being used. And these crucial corporate actions tell you a lot about the management's thinking. Are they thinking about building long-term wealth, or are they spending cash without any direction? So as a sharp investor, you have to be careful about whether the company is misallocating capital. Even a profitable company can destroy shareholder value when a company suddenly starts to invest or diversify in unrelated sectors, starts buying expensive assets, or only chases vanity projects. Because at the end of the day, just because you have money doesn't mean you have to spend it. That's why discipline in capital allocation matters a lot, and that is reflected entirely by the management decisions. Let's have a change of environment, shall we? Now, growth sounds good, but how that growth comes is very important. Is it from core operations or from a one-time event? Now, think about this. Any profit that a company makes by selling a one-time asset, does it reflect profitability in the core operations? No. That is why I like to focus on operating profit margin, because it shows what's going on, how efficiently the company is being able to create a profit from its core operations. Just got a parcel for mom. It's 8 p.m. It's her dinner time. So I've got some food from a restaurant. Hakka noodles, veg. A one-time event like a sale of an asset or an investment can surely boost net profit margins. But is it coming out of the core operations, or is it a part of other income? Why is the profit growth number so important? It's because what is the share price? Share price is EPS into PE, earnings per share. When the profit grows, earnings per share grows, and so does the share price. Sure, the profit can grow 30 to 40% for a couple of years, and that's fantastic for a share. But I'm not going to expect that to happen every year. Why? Because I compare it to the nominal GDP growth. So what can be considered a good profit growth? Well, now the profit growth can depend on so many factors, such as how aggressively it is expanding, whether it has products or services that are disruptive, is it a small company? One key benchmark to look at is the nominal GDP growth. Now, what is the nominal GDP growth? It is basically the real GDP growth plus the rate of inflation. So, if we consider the real GDP growth to be 5% and the inflation also to be 5%, so nominal GDP growth is 10%. 1 to 1.5 times of that, so 10 to 15% would be considered a respectable profit growth for a company. Obviously, this is just a general benchmark and it cannot be looked at conclusively. You should be looking at the profit growth, average profit growth of at least 3 to 5 years. And the last point of this video is price to earning, PE. It is arguably the most talked about ratio in ratio analysis. Now, what is PE? Price to earnings is the real full form. Whenever I'm explaining the concept of PE to people, I like to tell them that PE is actually people's expectation. What is the market expecting out of that share? Now, generally, a company with high profit growth tends to command a higher price, which means a higher PE. Now, that's fine, but only if it keeps delivering. Even if the company doesn't do badly, but if the numbers do not meet people's expectations, then the share price could come crashing down. So I am incredibly cautious around overpriced growth stories. So a good business is a great starting point, but the price and the valuation still matters a lot. A good business at a bad price is still not a good deal. So let's quickly go through the checklist. Is it a good company that I understand? Are the profits growing consistently? Are the ROE and ROCE ratios healthy? Is debt under control? Is the management trustworthy? Is there a real demand for the product? Does the company have a moat or competitive advantage? Are they using their profits wisely? And finally, is it reasonably priced? If most of these are a yes, then it's worth digging into deeper. Guys, I'm no expert, I'm still learning myself. But whatever I have learned by listening to countless interviews of ace investors from India as well as abroad, I'm happy to share my knowledge and information with you guys. I am creating a finance club located in Pune. Entry is free. Anybody who's like-minded, who has an interest in finance, just drop a comment below. I live in Pune, so anybody who's watching from Pune, feel free to connect with me. Hope you're interested in investing and personal finance. It would be great to catch up and have discussions about this. That's it for now. Thank you for watching this video, and I'll see you in the next one.